So this is a slide that is actually on our website, and James has done a piece on this, and it's emotional distance, about excuses that have come out literally over the last 80 years about why people don't want to invest. Our main goal as your investment advisor, besides growing your money, is to try to distance yourself emotionally from it. Because as you see, almost every year there is something major in the market that you could worry about, and over long periods of time, they really don't matter. You'll see in the chart coming up that what matters is the economy in the United States is growing. Is it 2%? Is it 3%? The number doesn't matter that much. It matters that we're growing. And over the last 80, 100 years, over the last 10 years, we've grown, and the stock market has appreciated considerably. So, that we heard the podcast I just did yesterday. We had someone who said they didn't want to invest now because the market's at a new all-time high. Well, the market was at a new all-time high in 2013 at around 2,100, and the market now is about 3,000 as far as the S&P 500. If you had said in 2013, I don't want to invest now because the market's at a new all-time high, you missed compounding your money by about 12% per year the last 6 years. So there's always opportunity, particularly in an economy that's growing slowly and consistently, which is what's going on right now. This is also on our website, and we get the comment, well, the stock market's it's gambling. It is not gambling. It's never been gambling. People have that opinion just because of their emotions with regards to the stock market. Stock market is very efficient over long periods of time about compounding your money. On the left axis, this is the S&P 500. It hasn't been updated to the last month or so, but as you can see, since 1990, the S&P 500 has gone from, say, 500, 600 to almost 3,000. And on the right side of the vertical is the earnings per share. The S&P 500 has tracked earnings per share of the economy and the stock market pretty consistently over time. It is the path of the economy that matters, and slow and steady matters more than that great feeling people had during the internet bubble when everyone was day trading stocks and making thousands of dollars a day. Those things aren't sustainable. As an investor, you want slow and steady over euphoric. Euphoric feels good, but evaporates very quickly. So it's not gambling, because the longer you invest in the stock market, the longer your time horizon, the better your odds of making money and compounding your money. How many of you are gamblers out there? Anyone? Jessica, great. So, as you all know gambling, though, the business of gambling, if you go to a casino, the longer you play, the higher your odds that you're going to lose. It's the odds. That's the house wins the more you play, because the odds are in the house's favor. The stock market is exactly opposite. The longer your time horizon, the higher your odds that you're going to have a good outcome. They can't be any more opposed in concepts than gambling is not investing. This is just to the point that slow and stable wins the race. What you see on the left-hand side axis is, in the blue bars, is the rate of growth of earnings in the stock market. So in the 1970s, you can see up there was very, very high growth in earnings per share. And you would have thought, well, geez, the stock market would have done great. This is earnings growth every quarter, year over year, huge growth. Stock market, absolutely nowhere. Do you remember the 70s, why that happened? Anyone remember the 70s? Inflation. So inflation was earnings were growing, but inflation was eating away the purchasing power of everyone in the United States. So what happened in the 80s? Inflation peaked. Earnings growth, this is earnings growth. It's growing, but it's growing at a slower rate, Look what happens to the stock market. So when you turn on the TV and people, yes?
So the earnings are nominal earnings as opposed to real earnings?
Yes. Yep. Yeah, I see very few times when people adjust for inflation, And, you know, I'm not going to adjust for inflation. It's nominal. So, yeah. You know, here's the collapse. You know, this is a depression. The stock market went down 55% in 2009, peak to trough. Earnings collapsed, but we stimulated the economy. Growth, you know, when the Obama years early on, when we stimulated the economy, we got back over 5% because the numbers were so low in 2009. They were easier comparables. But ever since, we've grown about 2 to 3%. And the stock market has loved it, right? In fact, the only big growth period we've had in the last 4 years was when? When was it last year? No, it was actually, that's a good guess. The growth in the economy happened, the peak growth in the economy is actually the third quarter of 2018. So it was 2 quarters after the Trump tax cuts went into effect, for the peak economic quarter. And look what happened to the stock market. It didn't like it too much because the stock market actually is a pretty good forecaster of are things going to get better or worse. So last year, in 2018, as far as I'm concerned, the stock market peaked in 2018 on January 28th, which is essentially when the Trump tax plan was passed. And we spent all of last year going sideways, up and down a lot, as the benefits of the tax plan were taken away by the Trump tariff discussions with China and Mexico and every one of our trading partners, and the Federal Reserve raising interest rates. So this is why we invest in stocks. Over long periods of time, stocks outperform bonds, bonds outperform cash. This is the last 10 years. This is the S&P 500 index return. You know, almost 15% per year. And as good as the returns have been in fixed income and in bonds, 4%. So by being in the stock market, yes, there's more volatility as we saw at the end of last year, but the compounding over longer periods of time is well in excess of bonds. And it should be. You're taking risk, you're owning companies, they're compounding your money. So on to what happened in the first half of this year. And I'm going to preface this by, people keep quoting year to date, and I think that's kind of almost it's not a good representation, because the lows in the market last year in 2018 were when? December 24th. So December 24th, the stock market hit 2350, which is the absolute low. So by January 1st, the S&P 500, was around 2450. So we're taking a very low starting point and picking the low starting point and saying, okay, if you put all your money in on January 1st, this is what your return would be. And I don't know anyone who went from 0 invested to 100% invested on January 1st. But what you can see from here, more so year over year, the 1-year return is about 9%. You know, so go all the way back to July 1st of 2018, point to point, the S&P 500 is up 9%. This is ranked by sectors in the S&P 500. Does everyone know kind of what they divide the S&P 500 up into 10 different sectors? Everyone's aware of that? So this is just ranked by return. And sure enough, technology has been, you know, the best group, both year to date and year over year. And then the other groups that have actually done really, really well for the past year, as you see, are healthcare, that outperformed the S&P 500. Utilities, which are those boring stocks that we have to pay a bill for every month, that outperformed. Consumer staples, which are the boring stocks like Pepsi, Coca-Cola, Procter & Gamble, those things that we consume every month, every day, have to go back to Costco and buy every week. Those outperformed. Real estate investment trusts have been great investments. Those have outperformed largely because interest rates have come down over the last year, so the value of the real estate sector has gone up. And then information technology. So the groups that have outperformed the last year are the groups that you would think would outperform when the economy is slowing, but not going into recession. When things are slowing, people run to safety, safety of utilities, the safety of staples, safety of bonds. Bonds have been a very good investment since September of last year. The reason information technology has performed so well is those big companies like Microsoft and Facebook and Google have grown through the ups and downs of the growth the last 3 to 5 years. You know, if you would have told me that Microsoft would be growing revenue at 20% a year, as big as a company they are, and they've been in the public markets now for whatever 30 years, if you would have told me that 10 years ago, I'd have said there's no way. They're growing revenue, 15 to 20% per year. And that's why information technology has been one of the leading groups in the stock market. This breaks down year-to-date performance into style. So I think most of you know that there's, we talk about there's large cap growth stocks, there's small cap value stocks, there's everything in between. This shows you that the main asset class that's outperformed everything else in the world year to date, as well as for the last year, is US-based large cap growth companies. So can anyone name a couple of those? No. That's okay though, that's okay. Those actually right now are large cap value stocks. The large cap growth stocks out there that are pulling this whole average up, Google, Microsoft, Amazon, Netflix, Facebook, those companies, which is honestly what's been going on a lot the last 10 years. And that's because interest rates are low, so those companies are growing very fast, they're taking market share from their competitors, and the market is rewarding them because it's easy. You can go buy Google or you can go buy Facebook or Microsoft, and honestly, there are portfolio managers out there, having done this for 25 years, that when they're uncertain about what the economy is going to do, when they don't know what Caterpillar is going to do with regards to their orders in China or Brazil, which is where Caterpillar gets a lot of their big orders from, they go run and they hide in Microsoft or Google or Facebook. When the economy starts to pick up, they don't necessarily sell Microsoft and Facebook, but they go run over and they buy Caterpillar, they buy John Deere. They're going to buy Boeing later this year when they get through the plane issue that they're having. Those are cyclical stocks more than they are growth stocks. So, any questions here? I do want to bring up something here, and stop me if you can at any time. But we added a new part to the website last week, and it's called Fictionary, and it's part of my podcast last week, and it is going to be a financial dictionary that we have for our clients and anyone who wants to visit our website, where we lay out terms and terminology that are used a lot in the financial press. So, and we think probably 75% of those terms are used incorrectly. So we give you the definition that people are using online or on TV or on other shows, and then we give you kind of what our definition is. We've done this, I think, over the last 6 months when we talk about Goldilocks, and we'll go through that, how they refer to it on TV very nebulously and randomly, and how there's data out there that you can look at if you want to, that we look at to determine, is it really a Goldilocks period for stocks? And there's a difference between Goldilocks for the economy and Goldilocks for stocks. There is a tremendous difference. You want Goldilocks for stocks, right? If you're an investor. So, and that's what we're talking about, investing, not just the economy. Here we go. International stocks. Most of our clients have allocations to international stocks by way of some mutual funds and ETFs. As you can see, overall, they've underperformed the S&P 500, which is what everyone compares everything to, because it's the largest index in the world. Growth international stocks have done better than value stocks, and large cap have done better than small cap. Just like the United States, just the entire international asset class world has underperformed the United States. We are and have been for the last 2 years the center of the investing world. When things slow down in other economies, whether it's China or Brazil or Argentina or Europe, people bring their money back to the United States and they invest in the United States for the certainty of the political system, for the certainty of the earnings, for the certainty of the growth, stability, pick a reason. And since things have been slowing globally since early 2018, the money has come, the allocation has come to the United States over the rest of the world. So. Any questions there? This is emerging market stocks, which people have love-hate with them. You know, over long periods of time, they are one of the top performing asset classes in the world. Over time, they are one of the most volatile performing asset classes in the world. We do have allocations for our clients, albeit relatively small, in emerging markets by way of generally dimensional funds, emerging markets funds. And you know, emerging market stocks have underperformed international stocks, which have underperformed US stocks. Question is, we get a lot, well, why do you own them? We own them because over 5, 10, 20 years, they contribute more expected return to your portfolio, right? That volatility that they have, that we've seen the last 2 years, over time smooths itself out, and the components of their growth outweigh the volatility in the stock. So, have they outperformed the last 2 years? No. Do we expect them to outperform the next 18 months? Yes. This is a area that has gotten a ton of focus, particularly this year. United States real estate investment trusts. Most all of you are own single stock portfolios or mutual funds and ETFs. You own a relatively large holding in a mutual fund and or some single stock real estate investment trusts. And they have done fantastic. This has been kind of the safety bucket of a lot of our publicly traded assets. And I mean, I don't know what to tell you outside of, you know, having a publicly traded real estate group up 17%, and now granted that was right into July. That's tremendous, right? And even year over year, if you go back and remember what the S&P did, it was right around 9.5% year over year. Real estate investment trusts, exactly the same. With less volatility, they're paying a higher dividend. They've done exactly what we expected them to do, and they've helped your portfolio in those ways.
Is that the growth of the stock or the growth plus the dividend roll?
That's that's period total return. But you know, what's helpful what's happened in the last 2 years, interest rates have come down. I'll show you a chart here in a little while. The bull market for bonds and fixed income, I believe, the team believes, ended in 2016. But when people say, you know, bull markets and fixed income or bear markets, they last 30, 35 years. They last very long periods of time. People have been people have been talking about, for 10 years, inflation's going to pick up. Well, it hasn't. Not overall inflation. It has in drug prices for a number of years, and then it does in another area for years. But up until maybe the last couple months, it hasn't shown itself in labor costs. It hasn't shown itself in other areas that flow into the earnings of the economy in the stock market. So, but once it does, and it will, given how much money the United States has printed and how accommodative the rest of the world has been, inflation does pick up, it creeps up, and it's not a bad thing for stocks. It is a bad thing for bonds if you own very long-term bonds, but it's not a bad thing for stocks at all. So, and we have some charts in the future right here to talk about the bond market and stock market and what we've been doing over the past literally 2 months. So here's fixed income. This is basically all the different bond markets. And I mean, they've done great, right? U.S. government bond, 11% year to date. But that's literally taking the top of the interest rate cycle that was last November at 3.25%, and the low in the bond market yield-wise this year essentially was 2% on July 3rd, June 2nd, someplace in between there. So point to point, we're not expecting the second half of the year to have fixed income returns anywhere near that. In fact, I believe they're going to be negative in fixed income the rest of the year. So.
Is that based on the rate cut coming up in 2 weeks?
So the rate, so we can get into this in a little bit or at the end. Federal Reserve will cut rates. The data says they'll cut rates. I, as your investment manager, I don't care if they cut 25 basis points or 50 basis points. I don't care when they do. If you waited around till they did it, you've already missed the market moving from 2350 on January 3rd. They came out on January 3rd. The Federal Reserve said, we've done too much. And the stock market literally started going straight up. Okay? Then again, on June 3rd, they came out and said, we're gonna go to easing. At that point in time, the stock market was 2750. By the time they come out and cut rates at the end of this month, whatever it is, the stock market will be 3,000, 3,050, maybe 3,100, and you will have missed 98% of the move based on the Federal Reserve cutting interest rates the first time. So I think the economy's fine. I think what's happened the past 6 months, 9 months, is people panicked about a slowing global economy. They ran into the bond market, and this is exactly opposite of what was going on last September. Last September, we'll see a slide here. Last September, at the end of September, the economy was doing good, right? I mean, you saw the data. That was the highest GDP quarter of the year. Every person on TV that I heard come on TV when interest rates, 10-year treasuries were 3.2%, 3.22%, everyone on TV that I saw, the pundits who know fixed income, said they were going to 3.5%. Every single one of them that I saw said the exact same thing. Okay? 3 weeks ago, when interest rates were then 2%, those exact same people came on TV and were telling me that they're going to 1.75%. How is that helpful? It's not. It's not helpful one bit to an investor. So the economy is fine. People ran too far to the fixed income bucket, and we have some data, and you'll see it. It's pretty interesting. And the economy is going to pick up later this year. Inflation will pick up in the third quarter, probably in the fourth quarter. After that, you're going to get higher growth in the fourth quarter and then through 2020. And under higher inflation, it doesn't matter if it's 1 or 1.25 or 2 or 2.25, it's direction more than amplitude right now. If inflation is picking up, you don't want to own a lot of bonds if you're doing tactical asset allocation, right? So, I mean, I think there's a better chance that interest rates are 3.5% on a 10-year bond by the time, if and when Donald Trump, and we're not going to get into politics too much, if and when he gets reelected, whether you like him or you don't, he wants growth in the economy. The Federal Reserve wants inflation in the economy. There is a better chance that interest rates are 3.5% by the time he's elected than there are 1.5%, assuming he wants to get reelected. So, did I answer your question on is it the Federal Reserve or, the economy's fine, and people just ran too far to the one side of the bucket. So inflation is picking up. It takes years. Inflation doesn't pick up in a month. It doesn't pick up in a quarter. It takes multiple years for it to start. So this is a great slide just on diversification and why we run diversified portfolios. You know, some of our clients are 100% stocks. Most retirees don't need to be 100% stocks, don't want to be 100% stocks. This is just a slide showing how allocation with stocks and bonds, you know, it does lower your return. The more bonds you have, the lower your return is going to be. The more stable your return is going to be, as shown by the standard deviation all the way there on the side of the slide. But we run diversified portfolios, whether they're all stocks, they're diversified among sectors and companies. You know, if your allocation has stocks and bonds, the bonds have some short-term investments. They have a little longer-term investments as well. So we run diversified portfolios. I will say, you know, as I just did, I believe the 30 to 35-year bull run in bonds, it ended 3 years ago, right? It'll probably take people 5 years to figure it out, and that interest rates will be going up. So this slide, 5 years from now, is going to look a lot different. So this gets back to, this is kind of going forward, what we think is going to happen. But this is what's happened. This is what happened in 2016. If you go to our website or listen to our podcast, I think you'll see that I refer to a time period multiple times, and I have all year and towards the end of last year, that is very similar to what we're seeing now. And if you turn on the TV, you'll hear people referring to 1997, 1987, you know, decades ago, multiple years ago. I think all of that is pretty much irrelevant. You know, the people managing money now, I'm worried, you know, the best data points are the last 10 years. And what happened in 2016, and how many of you, do you remember 2016 at all? What the concerns were? Remember the concerns in the economy and the stock market? The first half of 2016? No one remembers the election coming up in November, and it was going to be, if Hillary won, the market's going to crash, and if Trump's going to win, the market's going to crash. The majority of my friends in July of 2016 thought the world was going to end regardless of what was going to happen. It didn't matter who won, which is unbelievable to me. The market was going to crash, and it was going to be a recession. That was literally 3 years ago, almost today, okay? And this is a chart of how much money was leaving stocks in 2016. And it's also a chart of what the S&P 500 did during that same time period. And cumulatively, this is, let's see here if I got the right one. Yeah, this is the money going out of stocks, January 2016, all year. Out of stocks, out of stocks, out of stocks. Hate stocks, got to own bonds, hate them. Billions, tens of billions of dollars left the market, stocks. And where'd the stock market go? Up. This is a new all-time high. That's a new all-time high back in 2016. With the economy doing almost exactly the same thing. Every asset class held by investors doing almost exactly the same thing. And I'm not talking to the month or week, to the day. It is wacky. That's not really a professional term, but it's wacky. And I'll show you some charts. So, and I'm not to say it's going to happen exactly the same, but it is the same people managing the same money, and they tend to do the same things, which is behavioral finance, right? You don't have to go take 4 years of finance classes. If the same people are managing the same money, they're going to behave generally the same. This is this year, okay? This is euphoria. This is money going into the market in December and January, December 2017, January 2018. About $120 billion went into the S&P 500, into U.S. stocks between December of 2017 and January 2018. Why did that happen? Does anyone remember then? Happened because Trump was going to pass the tax plan. And people decided, oh my gosh, I have to buy stocks. And the stock market went up 11% in 2 months. Okay, that is a melt up, right? Definitionally, 11% in 2 months. And remember, 2017, we went up almost every day in a straight line. If you were in the market, you loved it. If you're an institutional manager and you're a fully vested, you loved it. But if you're someone who didn't have 100% of your money in the market, you hated it because your clients were calling you up and it's, why am I up 18% when the S&P 500 is up 22? It's like, well, you own some bonds and you're diversified and, you know, you're 80 years old and retired and you don't need 22%. You need some safety and stuff. But look at this year. Ever since, you know, September of last year, look how much money has left the stock market, or directionally. I know what the data is year to date. Year to date, $150 billion have left stocks, and $250 billion have gone into fixed income. Okay? Where's the S&P 500? Yeah, this hasn't even been updated. 3,000. So it's managing emotions, right? Emotionally, November, December scared me. Sell my stocks. We're getting emails from our competitors going 100% to cash December 17th. S&P 500 was 2,500. Okay? They were right for 5 trading days. 5 trading days. They were right. And I guarantee you none of them bought their stocks back, if they even started, till the stock market got to 2,800, 2,850. That is not money management. That's, you know, someone looking at charts and reacting and not having a strategy that in today's markets makes sense. They certainly don't make sense for trying to retire on and plan for. So this is a very long-term chart. I don't think anyone was alive when this chart started. But my guess is, you know, there will be some people alive 40 years from now. They're sitting in this room when that chart has got 40 more years on it. In the room, yeah, there'll be some. There's some sick. Good point. Troy brings up longevity all the time, and people aren't planning for, you know, they're planning for 85, and our models are planning for 100. Our base model plans for 100. So this is a very long-term chart of the S&P 500. It's also, the lower level is a long-term chart in bonds. This gets back to why those diversified portfolios look so good for the last 10, 15, 30 years. But it also gets to the point of why we don't think they're appropriate to manage to a number that's on the internet when they say your total return can be expected to be 8% with a 60-40 equity bond split. That can't happen with interest rates at 2%, right? They're basing those models on 30 years of interest rates declining from 16%. You know, I think I was 8 years old when my dad was complaining he couldn't get a 15% CD anymore in the 70s. It's one of those things you remember. I'm like, 15%? Wow. So, you know, this right here was July of 2016. And we believe it marks the low in bond yields for essentially, I mean, probably the next 25 years, right? And even if we get a recession, it's unlikely that long-term rates are going to go below, you know, 1.75%, 2%, something like that. But, you know, lower rates are good for stocks because they lift your valuation, right? I'm never going to suggest that lower rates don't benefit stocks. But what I will say is if you look at the minutia of that chart, all the big up moves in the S&P 500, so this stuff, you know, these big moves up, come when long-term interest rates are rising, not falling. Why would that be? Long-term interest rates rising, not falling. It's a positive correlation to the economy, right? And so when long-term interest rates rise, you either have one of two things or both. You have accelerating inflation or accelerating growth or both. Goldilocks is both. You get a little inflation and accelerating growth. And the reason that's Goldilocks is because the companies that you own in your portfolio can raise their prices a little bit, and their price increases offset any lost demand that they have. So every dollar they raise, their price on something, they keep more of it. It's in excess of their costs. So you start to get this compounding of higher earnings at an accelerating rate. So you don't want inflation running rampant. You don't want, and if we went to 4 or 5% inflation, we'd have big problems, okay? But at first, when inflation picks up, it is good for stocks. It's bad for bonds. It's bad for long-term bonds. It's pretty good for short-term bonds. If you own a 2-year bond, you get rates start going up, you get more money 2 years from now. You get more money 2 years from now. If you own a 30-year bond, you don't, right? You're not going to be able to reinvest it because your money is sitting out there for 30 years. 2 years from now, you have still 28 years of getting your money back at whatever the rate was when rates were lower. So this is a weekly chart of the S&P 500, and I'm going to bring you back. This hasn't been updated, but I'm going to bring you back to the same time period. Been there, done that. And I'm not a technician, but I watch what technicals do because there's so many people that believe in them. I look at them for valuation more than anything. When is that? It's the end of 2015, beginning of 2016. What time period did I say that we're replicating? Economically, stocks, assets. Economy slowed down, people panicked, sold stocks. The S&P 500 went down peak to trough in November, December was 19.9%. I'm sorry, that is a bear market, 20% rounding error, So, but it's still a bull market, right? Stocks are going up with the economy's growing, it's compounding your money. May not feel good because it's not going up in a straight line at 15%, which I think is what everyone wants, but that's not the way our economy works. It's not the way the stock market works. Love this. Anyone hear of Bitcoin, like Bitcoin, own Bitcoin? No? A lot of sold Bitcoin. I would not recommend shorting Bitcoin. It's funny because the folks around the office love to talk about Bitcoin at times, and they earlier this year I brought up, it was in early January, and I said, you know what, it's time to buy Bitcoin, and they all looked at me like I was insane, and I'm like, we're not going to buy it for clients, we can't do that, but it's time to buy Bitcoin, and people ask, why? Like, because Bitcoin, all Bitcoin is, as far as I'm concerned, it's the Federal Reserve and monetary supply. Is the economy growing? Is the Federal Reserve printing money, making lending more easy, making monetary supply easier, financial conditions, whatever you call it, are things easier? And this chart gets back to, once again, how we've seen almost the exact same thing this cycle 3 years ago. Don't go back 10 years, don't go back 50. This is Bitcoin, okay? And explain to me, this is back in 2013 through 2015-16. Explain to me, if we haven't seen this before, mathematically or otherwise, and if you want to go spend a week doing it and then call me back and help me figure it out, rationally, we'll do it. Bitcoin. This is not the first bubble of Bitcoin that's dropped. Dropped 84% from 2013 through late 2015, 2016. Okay? Bitcoin. Remember the bubble? Turn on TV, they had a little Bitcoin monitor. Hit 20,000 on, I think it was January 28th, which was the top of the Trump tax ramp. And over the next year, almost exactly, fell how much? 83.66% versus 84.19%. Okay? From the bottom of Bitcoin, it rose back in 2015-16 till it peaked. How much? 335%. Bitcoin from January 3rd through, I think it was June 3rd, rose 335.17%. That isn't a coincidence, right? And I don't know what Bitcoin is outside of it's a trading vehicle, but when people asked me in January where I thought Bitcoin was going eventually, and we don't own it for clients, and we won't own it for clients, I said 200,000. 200,000? How's it going to 200,000? And this is the mentality of people who speculate in the market. This is not investing. This is speculating and trading, okay? Here's the logic. Well, geez, if it's behaving similar to what it did before, what was this peak? 20,000, let's see. The bottom in Bitcoin in 2015, before it started to turn, was, I think it was 325, if I go back and look, okay? The peak was 20,000, okay? You know what the bottom was on January 3rd of this year? 3,250. So add a zero. How do you get to 200,000? Pick the top and add a zero. That's as much analysis is going into the price of Bitcoin when people come on TV and tell you you got to own Bitcoin, it's going to 500,000 or a million or 100,000, whatever the number is, right? 200,000 is good as any, right? And it took me 15 minutes to figure that out. If you're going to speculate. We do not speculate for our clients, but I like bringing it up because it's another representation that we've seen this story before, and you don't have to go back very far. There's the other one. This is gold, which everyone loves to talk about too, particularly people my age and older. I call this baby boomer Bitcoin. This too is the same thing. It works when the monetary supply is easy and people think inflation's coming in assets or in money. So gold has been working this year. We expect it to continue to work. We don't own it for clients. We sold it for people who brought money in. Literally, I think we sold it 2 weeks ago. We will not be buying it back. They're much better investments for your money that can compound your return, provide you income, whether it's a dividend or even a bond. The cost of owning gold outside of jewelry, we have a client who has a lot of coins. The commission to turn the coins in bullion into gold is 5 to 7%. So we can find better uses than gold. If you like gold, buy some, wear it, put it in a safe, enjoy it. If Warren Buffett doesn't like it and never has, one of the wealthiest and smartest men in the world in investing. Small cap stocks, I bring this up because we do have allocations to small caps and they've underperformed. They're up year over year, but they've underperformed. And I just want to lend a minute to another term. I don't think it's gone on our website. It's under Fictionary. Does anyone here watch the financial networks? Oh, I love that. There's a lot of head shaking, like, no. Are you just not admitting it? You don't want to confess in front of me, right? Yeah. So this soapbox, because I do it occasionally. Small cap stocks, great long-term asset accumulation tools because they grow faster than large cap stocks over long periods of time. Hasn't been the case this cycle. Every cycle, certain asset classes have Goldilocks periods. This cycle, as we've seen, it's large cap growth US, okay? But over long periods of time, small cap stocks outperform, have higher risk, higher volatility, bigger reward. That's why we have allocations there. As you see, let's get back to it again, Crash in small cap stocks. When is this time period? Oh, it's early 2016. Rallied, went down again. This is late June of 2016. Crash, just like the market. Okay, down 20% plus. It's not a crash, it's a correction. Crashes are 40, 50%. But rallied, down. We expect small cap stocks to outperform the market over the next 18 months. And we expect them to outperform by up to 25%. That's what happened in the second half of 2016 as people got more positive on the economy. It was happening before Donald Trump got elected, right? They weren't hitting new all-time highs, but they were close. They were darn close. So, as people take risk, as people get more comfortable that the world isn't going to end, that we're not going to have a recession this year or early next year or even the end of next year, people put money back into risk. And my soapbox is this: if you turn on the TV and you hear on one of these shows, as I have for probably a year, that portfolio managers are investing or investors are hiding in small cap stocks, turn off the TV. Because there is not one portfolio manager in the world who's managed any money who hides in small cap stocks, okay? And I've heard the term almost every day for multiple months. Last year, no one hides in small cap stocks. You can't, right? Because of these kind of moves. The market went down 20%. I think small caps went down about 30. You do not hide in small cap stocks. It's an asset class that you believe in to compound your money over long periods of time. That's exactly hide. They were putting money there because not necessarily they didn't want to, but they just thought that it was the best place to put money because the dollar was actually going up. They would come up with some rationale that wasn't small cap stocks work when the economy is getting better. Look at how well they did. The economy's getting better, getting better, getting better. The economy peaked, right? They went down, right? They are leveraged assets to the economy. They work much better than the S&P when the economy is accelerating, and they work worse when it's decelerating. That's it. But no one hides in small cap stocks. They hide in Microsoft, they hide in Facebook, they hide in Johnson & Johnson, they hide in Pepsi. They do not hide in an asset class like small cap stocks. 10-year treasury yield. So this gets to we believe they're better alternatives for your safe money than fixed income. This is the 10-year treasury yield. So in 2000, the yield was 6.5%. We can all remember 2007, 2008, 2009. The yield went to, a little less than 2%, something like that. 2012, the economy was still kind of lousy. 2016, which we've referred to multiple times, Brexit concerns was what was going on in July of 2016. U.S. debt default concerns were going on there. China concerns were going on there. There is a better chance in the investment team's belief that if Donald Trump wants to get reelected, which for all looks he does, 3.5% on 10-year treasuries, if and when he gets reelected in late next year, early 2020. We made suggestions that if you want to buy a second home, you go do it now. Mortgage rates are going to be as low as they probably are for quite some time. So particularly around here, with housing not turning over as fast because of Harvey or whatever the reasons are. So. This is emerging market stocks, same story. They don't outperform the S&P 500 as an asset class when the economy is slowing. They do outperform when the economy is getting better. So we have weights in our portfolios in emerging market stocks. They're up year over year. They're not outperforming the S&P 500. They will outperform if and when the dollar starts declining again. The correlation to emerging markets, the correlation to international stocks is very strong when the dollar is going down. Just kind of the rules that are out there. People also don't hide in emerging market stocks. So let's see here. That's the S&P 500 weekly chart. And yes, we had no idea what was going to happen in the market, right? We don't know, right? Everyone asks for a crystal ball. This is crystal ball stuff, right? However, the economy has been growing at 2 to 3%. So economy keeps growing 2 to 3%, we're going to get nearly the same outcome that we've gotten the rest of this cycle. So here's the S&P 500. the market is never going to go anywhere because Donald Trump's going to get elected, or we're going to socialize medicine because Hillary's going to get elected, and Donald Trump got elected, and it's a business-friendly environment. Growth has been 2.5%, 3%. It hit 4+ for 1 or 2 quarters. You know, stock market's done really well. This peak right here is the Trump tax plan peak. And definitionally, when all those people who aren't listening to the TV or wouldn't confess to it, you'll hear melt up on TV too. A melt up, we have not felt a melt up since this time right here. This is a melt up. The end of 2018, end of 2017, beginning of 2018 is truly a melt up. The S&P 500 went up 11% in about 8 or 10 weeks after going up in a straight line for almost 18 months. That's a melt up, okay? Up and to the right isn't a melt up. A melt up is when there's exponential and accelerating growth in the stock market. It's far in excess of what our economy grows at, right? We know we're not growing at 5 or 6%, but the stock market went up 11% in 2 months, which is why we went nowhere for 18 months. It took us 18 months to get through the anticipation of the economy growing from Trump tax cuts or whatever else was out there. It took us 18 months to get through that with the economy growing. Valuations got panicky low on December 24th. I sent out a podcast from our new offices. I was sitting, I think, on the only chair in the office, basically saying we're buying stocks. We do have measures we can look at that say volatility and panic has gotten extreme, and instead of taking 4 to 6 months, which is what we normally do when we move money around, we got some investors fully invested within 4 to 6 weeks who had brought us money in early December. So that's the monthly chart. It looks scary, right? If you just sit there and look and go, oh my gosh, look at where it's gone. New all-time high back here in 2013. You missed out compounding your money at 12% a year for the last 5 years. In the indexes, right? I'm talking about indexes, and no one here has an indexed portfolio. You have a structured portfolio for your goal and objective. So it's not going to look like the S&P. It'll have less risk than that, more than likely, but just the market overall, that's what that's done. So this is our second half outlook. It's on the internet for everyone to see, everyone to hear, because we released it first in audio. The first half, January 3rd, the Federal Reserve walked back its interest rate increases. The S&P 500 was 2450 on that day. It was up about 100 points from December 24th. June 3rd, the S&P 500 was 2750 and going straight down, if you remember, on June 3rd, because our president decided he was going to launch tariffs on Mexico the prior Friday. But on June 3rd, which was a Monday, the Federal Reserve said, we're going to cut rates. The global economy is getting too weak. We're going to eventually cut rates. The S&P 500 was 2750. On July 1st, right during the timeline window that we had thought, Donald Trump decided I'm going to get reelected as president, and he decided to put all the tariffs kind of on hold with China. They're negotiating. He'll get something done. He'll call it the greatest deal ever. It'll be better than nothing. So what does the second half look like? So we're pretty much where we expected to be, when we expected it to be there. The S&P 500 is 3,000 right now. It can get to 3,050, maybe 3,100 in the next 6 weeks, but we do not expect it to stay there during the third quarter, fourth quarter. We expect there'll be something in the third or fourth quarter that people will come up with that there's probably a good chance of a 5% pullback in the market. That's it, 5%, okay, which would take us right back to 2875 or something like that. 5%, not the 5 or 10% that everyone can say on TV, which drives me bonkers as a former engineer. Because what other business can you say 5 or 10% and be 100% wrong and call yourself right? Mm-hmm. All you ex-salesmen, if you went into your boss and said, well, I might sell 1 million or 2, this quarter, they wouldn't let you do it. So will we be wrong? Yeah, it's not going to be exactly 5%, but that's the best, most likely outcome as people start to take gains. Because if you bought stocks in the down move in last November or December, or even a little earlier, you've made some good money. People want to lock in some gains because they're also going to be looking at, oh my gosh, remember what happened in November or December of 2018. And the majority of December of 2018 was caused by panic by people who put money in the market early in the year at all-time highs on the Trump tax plan, and by the end of the year had losses and decided, I'm going to take a tax loss in December, okay? And they decided to pull their money out. I'm taking a tax loss. Well, there is no one in December generally buying stocks. People are shopping. People aren't investing, right? Pension funds are on holiday till the end of the month, essentially. So every investor, and a lot of them are in index funds, a lot of them are in ETFs that are passive investment vehicles and are price agnostic. They do not care what the price of what you're selling is on the way up or the way down. If you tell them I'm going to sell $100,000 of something or 100 million of something, it is out of the market the next day, whatever the price is. And that's what happened in December. That's why there was no upticks in December till the end of the month almost. And at the end of the month, the big pension funds, who have horizons longer than a year, said, we're going to buy stocks. And that's how the market actually bottomed. So we expect, the stock market actually to end the year probably around 3,100, which is where we're getting close to. But the outlook for 2020, as inflation picks up and as growth picks up, as our president tries to focus on getting reelected, is such that, and you can't hold me to this because it could change at any time, but we put a projection out there for 2020, what if, way in advance of everyone else. So if you went back and looked at these cycles, what if Trump decides he wants to get reelected, the economy starts to accelerate, your bonds are going to sell off. You will lose money in your bonds. Well, we actually sold a lot of bonds for people who their allocations are such that we can do that. We sold them in the last 4 weeks. Doesn't mean we won't buy them back, but we sold them, we took some gains. The way this year should play out, we've got a bunch of PE expansion already from the Federal Reserve cutting rates. That's what's happened to get us to 3,000. The next step is inflation needs to pick up to get earnings to actually grow. That is likely to start to show itself in the market in fourth quarter earnings. And it should build all of next year. And as inflation picks up and real growth picks up, you get not only PE expansion, because the Federal Reserve is not going to be cutting rates too much next year during the election. They're not going to raise rates. They're going to be on hold next year for the most part. You get PE expansion plus earnings growth. And that's Goldilocks. That's what brought you 2017 that everyone wants to repeat. And 6 months ago, I said never would repeat itself in the history of my lifetime. And I changed my mind about 4 months ago. If 2017 is going to repeat itself, it's going to repeat itself next year. And I'm not saying it's going to. I'm saying if it's going to, it's next year. And what that looks like into the election is an S&P 500 on election day of somewhere around 3,550 to 3,600. That's assuming he's leading. If one of the Democrats who's very socialist leaning is winning, the market's not going to be anywhere near here, right? I mean, not even close. And we put that scenario on the website as well, right? We call it no Goldilocks. Yeah. This is the Go-Goldilocks, and I want to trademark this before it gets taken. This is Goldilocks plus Go-Go plus a melt-up, So if you were to go back and look at 2016 through 2017, the interesting thing is if you were to line everything up, the number you get for 2020 on or around the election is 3,550 to 3,600. And a melt-up from them, yes?
So what happens if we sort the China thing out? What will that impact be on this?
It's going to be this right here. That's it, this right here. Yep.
This is assuming we sort the China tariff.
Yeah. He's going to solve it. He's just, is it going to be great? Probably not. But so long as it's mediocre, this is likely what's going to happen. right? It's about direction. Is he going to make it worse or better, right? He's getting calls every day from people who are irate about cost of business doing up, and he's been on this for 18 months. Remember, he had a timeline. It started during the tax cuts in January, and I guarantee you he gave his advisors 18 months. There's a reason why it was July 1st when he said, okay, we're going to have a great deal. We have a truce. It was almost exactly 18 months because he has about 18 months to get reelected, maybe not even that long. So he is going to focus more on that, which is growing the domestic economy. I wouldn't be surprised if one of his big policies that comes up later this year, fourth quarter or the beginning of next year, is economic zones here in the United States, where all these plants that are already moving out of China, because their labor costs in China have gone up a lot. People were already moving plants out of China. They were moving them to Taiwan and Singapore and Mexico and name a place, because China has grown so much the last 20 years. Their labor costs have gone up. I wouldn't doubt that he starts to talk about economic zones where you get tax benefits for putting a plant, in Texas, or Texas is probably a bad example because no state income tax, but someplace. So in Michigan or some other places that he needs votes, And it makes sense. Those companies are moving their plants anyway, right? They're moving them back closer to home. Yes?
Can you talk a little bit about where we see opportunity over the next couple of
Yep.
months preparing for this?
Thanks, Troy. So Troy asked, and I apologize for listeners on the internet. I haven't been repeating the questions, and our audience is not mic'd. So Troy asked, where do we see opportunity in the next 6 months? We see, although we think there's kind of a pause in the market to a pullback in the market through November after this run-up in August, there is tons of opportunity. And they're exactly in the names you mentioned earlier today, in Boeing and Caterpillar and Deere, in technology, in financials. I ran a financial service fund for 2.5 years over at AIM. We have not liked financials for, ever since I got here, essentially. We started buying financials, albeit early, the last 3 months, 4 months. We accelerated our purchases over the last 4 to 6 weeks because an economy that's getting better, economy that's stable to getting better, inflation going up, people run back into financials. The yield curve steepens. I don't care if the Federal Reserve cuts 25 or 50. It's already in the stocks outside of maybe a week. The stocks will go down for a week and then they'll go back up because the economy is going to get better, not worse from here. And so, we do own, JP Morgan for clients, and we own some Morgan Stanley. And are they going to miss numbers next week? I don't know. But I know if they're down for a day and a half, which is generally what they are nowadays when they miss, the companies will be in buying their stock back 48 hours afterwards. So there's tons of opportunity in the market because these big pools of money that are passively managed, they stay fully invested and they run to one side of the boat or cruise ship. They've run to real estate investment trusts. They've run to utilities. They've run to staples for the last 9 months. They've run to bonds. And then when things pick up, they sell all those or they don't buy anymore, healthcare, and then they run over to the cyclical side of the ship, which is consumer discretionary, it's industrials like Boeing, it's United Technologies, a lot of those kind of names. So we're seeing lots of opportunity in segments of the market that people have disregarded. We saw those same opportunities last summer in names like Disney and Pepsi that no one liked. No one liked Disney when it was $90 or something like that last summer because ESPN was going to zero and all these excuses. Well, the stock had gone nowhere for 3 years as earnings had grown at 12 or 14%, something like that. And finally, they got this new Disney Channel streaming service coming out. And by the time it came out, the stock was already 120, and now it's 140. So we're not buying more of the more boring, stable names. We've been buying more of the cyclical and growth names. So thanks, Troy. So yeah, so this is best case scenario. This is he has a good deal with China, or he has any deal that's stable, and he starts to focus on domestic economy. And the kind of mathematically, the funny thing is, and I'm not guaranteeing this by any stretch of the imagination, never would, and I'm going to look really silly if it doesn't even come close. But we do have the downside scenario out there on the internet as well. But this on election day 3,550, 3,600, plus the exact same melt-up of the Trump tax plan that happened from mid-November 2017 through January 24th, 2018 was 11%. Add 11% to 3,600 and you get 4,000. That's a melt-up. That's, we will be reallocating money away from stocks, particularly cyclical stocks and growth stocks, very quickly for our clients and into more safety assets. Yes? What could the Democrats do to sabotage the economy in front of the election? Little to nothing outside of continue to go after the administration on ethical violations, and try to get his ratings down. But the economy, the Federal Reserve matters more than politics. Always has, always will. If politics mattered more than the Federal Reserve, I'm sorry, I am conservative, we would not have had the great stock returns we had during President Obama's administration. Right? He was anti-business, higher costs, higher healthcare costs, higher taxes. The Federal Reserve matters first and foremost. Are they stimulating the economy? Is money easier? Are companies going to go out there and borrow money and increase projects? If they look like they're gaining traction, it would be very bad for the stock market, right? Your tax cuts of Trump, they'd be looking to reverse them come the new president. Healthcare costs would go up dramatically from an insurance standpoint, I'm sure. They'd go after Facebook, Google, and every other technology company to regulate them. I mean, you know the agendas of the extreme left, you know the agenda of the extreme right. So, we are still a country of moderate opinions overall. We just hear the extremes louder than anyone because they have the voice on the internet and the voice on TV. So, yes?
Iran is a powder keg right now. If they continue to persist, as they have in the last month or two, taking out tankers,
Yep.
taking out our spy planes, if hostilities break out, how do you see this affecting the market?
So if hostilities break out in the Middle East, it would be bad. It would be great for Houston. Everyone would cheer because oil would go to 100, 110. And the stock market would not like it because it's the wrong kind of inflation. But I honestly don't think it would do much to the overall stock market for very long because of the amount. We are no longer reliant on energy from other people. I'm sure your friends and neighbors are in the energy industry, and just what's going on in the shale has made us energy independent. We've been exporting oil now for, 3 or 5 years? I can't even remember the number. I'm not the specialist. But it would be bad, but does Trump want to get reelected? Do you really think he's going to go in and do something in Iran? If he's going to do something, he's going to do it in the next 3 or 4 months. He's not going to do it right before the election. So, I would actually honestly hope that something happens over there to get oil prices to spike a little and get 5% down in the stock market. So we're energy independent. And I don't know if you have kids or grandkids, but I know the usage of my children who are 19 and 21, as far as oil goes, is almost non-existent, right? They have no desire to own cars, they Uber everywhere. The demand side of our economy here in the United States from a demand side in oil and energy products like that is going to be declining generationally. It just is. So, in my opinion. They do, but they do use gas, but the efficiency, how old are your kids? My kids don't go to the mall. They don't go to restaurants. When they date, it's, they take an Uber. They're not driving all over the place in these short haul manners, and we're stripping all of that out. Right? Auto companies, right? I don't know what you do as Ford or GM. My kids have barely a desire to own one car, let alone 2 or 3. Right? And it's technology that's allowing our economy to do that and become more efficient. That's kept inflation down, right? I mean, it's made us more productive as an economy, and it doesn't show up in the numbers, but it just means that there's new trends out there that we have to take advantage of as an investor. So, do millennials travel more? They seem to. They definitely seem to travel more than acquire stuff currently. Millennials have definitely delayed their years of accumulation. So this is just a final slide before I open it up to any questions and answers. I talk about the blackout window during a lot of my podcasts, and some people are like, what is it? And this is graphically what it is. The blackout window for companies in the stock market is a time period late in the quarter. So if a quarter runs from January through the end of March, the second half of March through the time a company reports earnings, which is usually 2 weeks after a quarter ends, a company can't go into the market and buy back their stock. Okay? They can't do it because they have material non-public financial information. Okay? So what happens is there's like this pig in a python, I guess. Every quarter, when more and more companies within the S&P 500 are not allowed to buy back their stock. And as that buyer gets pushed out of the market actually becomes more volatile. And you'll see, actually, if you went back and looked at the monthly performance of the S&P 500, a lot of these down moves in the market come during this blackout window, where increasingly more and more of the companies can't buy back their stock until time period like starting around July 4th of this quarter, a couple companies reported, so the number might be around 7 or 10% of all S&P 500s can buy back stock. 3 weeks from now, it'll be almost 100% because all the companies have reported. 48 hours after they report, they can go in and start buying back their stock. And stock buybacks, whether you like them or not, whether you call them financial engineering with a negative connotation, which happens on TV all the time and drives me crazy, they are, if allocated properly, positive outcomes for shareholders, right? It's all dependent on what the management team is doing with the money, right? Bed Bath & Beyond buying their stock back from 60 to 10, obviously a horrible decision given Amazon was taking all their customers and they're losing customers to Walmart and everyone else. But if you don't have a lot of good alternatives in your overall market, and you're not facing lots of competition and don't have to expand, buying back your stock is not a sin. It's a sin if you're doing it when other people are trying to compete against you and your return on invested capital is declining. So yeah, we're exiting the blackout period now. It will start to build again late August through September. And that's all I've got. This is kind of the beginning of our fictionary right here, commonly heard financial terms. I'm going to trademark this one. So if you have any questions about terminology, send me an email. I'll try to explain it the way they explain it on TV. And if we disagree with the way they explain it, we'll give you that meaning as well. Yes?
So you talked a lot about the Trump tax code. Could you explain who benefited from it? Because whenever I demonstrate the big part, it was only for the rich.
So
the big corporation.
Yeah, who benefited from the Who benefited from the Trump tax cuts? People who do own assets benefited just because the way the rate structure was. However, the overall rates that lower or moderate income individuals were paying went down as well. So from a dollar perspective, given we have a progressive tax system, yes. From a dollar perspective, a lower tax rate will help the rich more because they make more money. But you can look at the statistics. They also pay almost all the taxes, dollar figure-wise, right? And a percentage-wise. So it's helped everyone. Did it help companies? Their marginal tax rates went down. They buy back stock. They also increase their capital expenditures. One of the reasons a lot of the companies like Caterpillar and Deere aren't doing particularly well right now is because after the tax cuts, people went in and they bought some capital goods in early 2018. That was 18 months ago, right? So, I think everyone benefited, but it's just an opinion on, should have we done it or shouldn't have we done it? I think it would have been better if we didn't, from a country standpoint, because we didn't need it. But it juiced the stock market for 2 months, and it increased GDP growth to over 4% for 1 or 2 quarters, And where are we now? 2 to 2.5%. So there's not a lot the political side can do to get the economy growing any faster than its inherent growth is. And right now it's low and stable, which is not a bad thing. Yes?
One place on the tax thing where, for instance, for me, I mean, my taxes went up that last year a whole lot more than they had the year before.
The question is there an area on the tax code that went up dramatically? I'm going to ask Troy, who memorizes all the tax tables, to help me out with this one.
Most people who saw any kind of type of tax increase was from the loss of deductions. So if you have a lot of properties or itemized deductions, the only way anyone's taxes would have went up with the tax cut was through the loss of deductions for the most part. But it also created much higher brackets, and this is, I'm going to come up there.
This is Troy Sharp, our founder, or one of our co-founders with his wife Jessica, coming up to address a question on taxes.
So I had a business this morning, and we were looking at sequencing, where to take income from the different accounts. Who asked the question? So what it did is it increased the brackets. It made the brackets more wide. And for many people in retirement, what this did is it made the 0% dividend tax bracket more obtainable. So when you retire, most of us know this, we get to choose where we take income from. So what the tax, from a strategic standpoint, what the new tax law did, it gave us a greater opportunity to take money from our capital gains and dividends accounts and stay in the 0% tax bracket. Now, if you have $125,000, $150,000 a year of income, you're going to be outside of that 0% bracket. But strategically, what it did was increase the brackets. It made them, instead of being down here, or one way to look at it is more wide. So you can take more money out of your accounts, and whether they're IRAs or non-IRAs, you can stay in the much lower brackets. But the only way anyone's taxes would have went up would have been through the loss of deductions. Yeah, I know that's a little bit confusing, but does that make sense? So there's a 0% tax bracket for your capital gains and dividends. Many people have accumulated gains that, if we are careful where we take the income from, if you're married filing jointly, you can have over $100,000 of income and pay 0% tax on your dividends and capital gains. But if you're taking from the wrong places, then you violate those corridors, and now you're paying more taxes than you should. So it's really about strategic distribution, and that's the part of the tax code that makes our job really exciting, because when we get intelligent about where and how much we're taking income from the various accounts, we can pay a lot less tax under this code. And I don't know if you guys have heard about the new law, the Secure Act that's going through. We have a new video coming out about this. But a new law is going to pass by the end of this year where they're going to force your IRAs to be fully distributed upon inheritance over a 5 or a 10-year period. So this is the lowest tax rates that we've had in your lifetime to take money out of your accounts. And it's going away in 2025, after 2025. So there is a lot of opportunity for tax planning and strategic distribution with the new tax code. So,
Thank you, Troy. Any other investment questions or anything else?
Question back to one of your early charts, the S&P versus the earnings per share. How much of that chart is influenced by the large company buybacks?
I'd have to get back to you. I don't know.
But that's part of the influence of.
Oh yeah. So, you know, the number of shares in the market has been declining because of stock buybacks, as well as the number of stocks traded in the public market has been declining over the last 20 years. There's a
Second half of that then is when Amazon buys back 1 million shares, that does come out of the float that's recorded on.
Yes, although Amazon may be a bad example because they have compensation systems where they hand out so much stock, but yes. Yep.
$1 million of their shares, that's reflected out of the float.
Out of the flow off the balance sheet. Yep. Goes to increase earnings, assuming they aren't issuing more shares to their company employees to dilute that buyback, which a lot of those tech companies do. which is also why they don't buy back a lot of stock. Microsoft has been buying back a lot of stock. It's a 30-year-old company. They generate huge amounts of cash. They're not expanding their workforce at 10 or 20% a year like an Amazon is or like a Facebook is. So, yes.
I'd like your thoughts on the Phillips curve. There's been some discussion about some of the people nominated for the Fed that don't believe it anymore, and so I'm curious about your thoughts.
Can I ask an economics question on the Phillips curve, and I'm going to defer to another time because I took a lot of finance classes. I took a lot of economics classes. At the end of the day, almost none of them matter to investing. They're great to talk about theoretically, but from a practical standpoint, I mean, you can see it. $150 billion left the stock market year to date, and stocks went up to 3,000 on the S&P 500, right? I mean, can you read that or learn that in an economic textbook, which I've read a ton of them, but you know, I'm just trying to use 25 years of experience to help you in moving the money around to best allocate, have the best opportunity of meeting your financial goal and objective with the least risk. And we make mistakes, right? I make them all the time. I admit to them pretty readily because I feel them, right? I feel them for you. I feel them for myself. I wear them very apparently. You can ask our team, like, God, Chris is kind of crabby today. I'm like, yeah. Like Friday, yesterday, fantastic day for our clients. Unbelievable. Till around 1:15. You know what happened at 1:15? A company, it's probably a top 5 holding for single stocks holders here at our client, with our clients, a company called Johnson & Johnson stock suddenly, inexplicably, was 140 and started going down. In 5 minutes, went to 134, right? Almost everything on my screen that we own for our clients is green. You know, the market was up huge yesterday, or the market was up 0.5% yesterday. And Johnson & Johnson, which is one of our largest holding, is just going down. And I'm like, okay, James, what do you see? You know, nothing, no story. You know, we're looking everywhere. I'm like, okay, it's got to be something on talc powder because that's the latest thing. And sure enough, you know, 15 minutes later, and the stock's already 133 and a half. 15 minutes later, there's a story, and we don't subscribe to Bloomberg, but it's on Bloomberg saying they're being, the probe may become criminal. And the stock's already 133 and a half in 5 or 15 minutes. And the stock bottoms when the headline is on CNBC or wherever the news show is that's not Bloomberg. And I think it rallied to like 135 and a half. That one stock, one move, ruined my entire day. And the other 19 stocks that were up, I mean, we had stocks for your guys' portfolios yesterday up 3 to 5%, you know? And that one little thing, it bothers me, right? I take it personally. We're not perfect. We're never going to be perfect. We're doing the best job we can for you. But I do wear those things personally because, you know, you guys have entrusted in our team your assets, right? And that's a big deal, right? We are fiduciary. You know, I did this for years for big institutions where I would never see your guys' faces. In fact, it was a job of about 1,000 people when I worked at a big mutual fund company here in town to keep you guys away from me, right? The only time you were a number on a spreadsheet. The spreadsheet went from $13 billion when I started to $33 billion when we turned the fund over. But I never saw anyone on that spreadsheet. The closest I came to a customer was someone who was about 3 steps removed from the end money that was put into the mutual fund. We would talk to wholesalers, and then wholesalers would talk to brokers, and there's just a big funnel. And you know, we get to talk to you, sit down and meet with you face to face. And you know, that raises my level of responsibility and connection with you guys, and I take it personally. So, you know, it doesn't matter that we had clients who I think are maybe 70% single stocks, up close to 1% yesterday when the stock market was up 0.5%, and J&J, which is one of our top 5 holdings, was down 4.5%. You know, one time I think it was down 6% intraday. You know, that one bothers me because I'm like, you know, you can't see everything, but we do try to build portfolios that manage around that risk. And if we've come to believe that J&J has big problems in this field or in the cancer drug field or some other area, we'll sell the stock and move on. So, but for now, we don't see those things.
Question about the Phillips curve, just real quick. That email you sent me this past week with when the Fed cuts rates, what the market's done 100% of the time.
It's gone up. Yeah. I mean, people, if you turn on the TV, you'll hear this time it's different, which is the absolute worst thing you can hear in financial markets or anything else. I don't know why it would be different. You know, I've heard this time it was different since January 3rd of this year. I have a lot of friends who still run hedge funds. January 3rd, when the Federal Reserve came out and said we're switching policies, the market was 2350 in the S&P 500, and everyone's like, oh, we're going to go into recession. I'm like, generally doesn't happen that fast because the economy was still growing at 3% then. The Federal Reserve eases money, you know, things settle down. You know, it takes time. So Goldilocks is an environment of 2% to 3.5% growth, maybe 4% at the top side, accelerating inflation, accelerating growth. You get earnings expansion, you get PE, multiple valuation expansion. That's how you get to a number that you probably shouldn't get to on the S&P 500 if Trump gets reelected into inauguration. You would get to a number like 4,000 on euphoria. That's euphoria. That's not a normal case. That's like an extreme case. Just like 2875 in January of 2018 was an extreme move, 11% in 2 months. It took us 18 months of going up and down, up and down, up and down to run all that through the system. And we've run it through the system, and the economy's growing, and the stock market's starting to go up again. It's 11:30. Who wants to eat barbecue? Thank you very much for your time. If you guys have any questions, comments, you know, send us an email, give me a call. I'm here all summer. My wife's going on vacation next week for 2 weeks. I'm home with my 3 golden retrievers. So.